Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive. Welcome to the deep dive. Today we're looking at something, well, really fascinating, where farming and finance collide. How the weather, something every farmer lives with daily, is becoming a big focus in the financial world.
It really is a crucial intersection.
Yeah. So for this deep dive, we've gathered various sources, articles, research papers, things looking at financial markets, ethics, regulation, commodity speculation, and specifically these things called weather derivatives.
Right.
Our mission today, to unpack all this, figure out what these weather derivatives actually are, how they fit into the bigger picture, and, crucially, what it all means for you, the farmer. We'll look at risks, maybe some strategies.
Absolutely. It's complex, isn't it? How these seemingly distant financial concepts can directly impact agricultural production on the ground. And the sources really underline something important. Regulating these markets has always been this sort of tug of war.
Between what?
Between efficiency, making markets work smoothly, and, well, fairness, keeping things equitable. That balance is key.
Okay, fairness and efficiency. Let's keep that in mind. So let's start with the basics then. What are these weather derivatives we keep hearing about? They sound a bit like insurance.
They do, but they're different. Think of it this way. Insurance pays out if something bad happens, like hail damages your crops. Weather derivatives, based on what Simtrade and Reuters say, they're financial contracts. Their payout depends only on whether a specific weather condition occurs.
Like what kind of condition?
Maybe temperature exceeding a certain level for so many days, or rainfall being below a specific threshold during a key growing month. It's tied to the measurement, not the damage itself.
Okay, so it's not about proving loss, just about the weather hitting a trigger.
Exactly. The purpose is to help businesses offset losses from bad weather, even if there isn't that direct physical damage that traditional insurance covers.
So say a really hot summer reduces yield, but maybe doesn't trigger your crop insurance. A derivative could pay out just because the temperature index was hit.
Precisely. It helps cover that lost revenue. It kind of fills a gap between standard insurance and the real financial risks of climate variability.
Interesting. And are these like standard things you buy? Or are they custom?
Both, actually. Many are traded over-the-counter, OTC. That means they're private deals, maybe between a bank and a big farming operation, highly customized.
Okay.
But there are also standardized contracts. You can find them on exchanges like the CME Group. They often list contracts tied to weather indices for specific cities, things like heating degree days, HDD, or cooling degree days, CDD.
HDD, CDD. What are those exactly?
Basically, they measure how much the temperature deviates from a baseline, say 65 degrees Fahrenheit. Higher HDD means colder weather, more heating needed. Higher CDD means hotter, more cooling.
So you could effectively hedge against, say, an unusually cold spring or a scorching summer in a particular location.
That's the idea, yes. You could use a contract based on the cumulative HDD or CDD for Chicago in July, for instance.
Got it. And the sources mentioned they're flexible in other ways, too, like timing.
Very flexible. You can tailor the contract duration maybe just for that critical pollination window or a harvest period. And the payouts can be structured differently.
Oh, so?
Well, you could have a linear payout. You get X dollars for every degree the temperature is above a certain point. Or it could be a stepped payout, a larger lump sum if a really extreme threshold is crossed, like severe drought levels of rainfall.
Okay, lots of options. But there must be a catch.
There is, and it's a big one highlighted in the sources. Using these effectively isn't simple. It demands a really thorough knowledge of your specific operational vulnerability.
By a specific vulnerability?
Yes. How does your farm, your crops, your logistics actually respond to different weather patterns? And you need reliable local meteorological data.
Why local?
Because if the contract uses data from an airport 50 miles away, but your farm's microclimate is totally different, well, that contract might not pay out even when you are suffering from bad weather. It might be useless.
Right. So precision is key. You need to know your exact risks and have good data that reflects your reality. It's not a one-size-fits-all thing.
Definitely not.
Now, the sources point out that climate change and more extreme weather are, well, obviously increasing interest in these tools. Can you give us some real-world examples from the material about how weather actually shakes up the markets?
Sure. SimTrade gives some good examples. Weather hits more than just crop quantity, right? It affects the quality too. Too much rain might mean lower grade grain.
Hmm.
And it affects logistics. Think floods washing out roads or extreme cold freezing rivers used for transport. All of that ripples into supply, demand, and ultimately prices.
Okay.
There's a case study in SimTrade simulated, but based on real dynamics about a French wheat producer, Blé de France.
What happened there?
Well, bad weather hits their region, so their own harvest volume drops.
Yeah.
But that same bad weather contributes to worries about the global wheat supply.
So global prices go up.
Exactly. So the farmer faces lower volume to sell, but maybe gets a higher price for what they can sell. It creates this really complex mix of uncertainties, volume uncertainty and price uncertainty.
That is tricky.
Yeah, and SimTrade also simulated broader market reactions. Favorable weather globally. Prices tend to stay stable, maybe even dip. Moderate problems, a modest price rise. But severe weather, like a big drought hitting a major growing region, that can cause futures markets to rally early, just on the fear of shortages, and then sharp spikes if the damage is confirmed. Understanding those potential paths is vital for anyone trading or managing risk.
So a drought in Kansas doesn't just hurt farmers in Kansas, it can send shockwaves through global commodity prices pretty quickly.
Instantly. And that volatility, that's what financial products are designed to respond to, either to help manage the risk or, as some sources argue, to profit from the swings themselves. Reuters notes that players like energy companies, hedge funds, commodity traders, they're using weather derivatives more and more. They explicitly say it's because they believe extreme weather is getting more common, more intense. They see it as a growing market factor.
Which leads us straight into the ethical side of things. This is a big theme in some sources, right? Betting on weather, speculating on food prices. How does that mesh with fairness, especially for farmers?
It's a huge question. The CFA Institute source gives us that core idea. Financial regulation is always trying to balance efficiency and fairness. And fairness is critical. It's not just about making markets work fast. It's about protecting people, ensuring trust.
And how does fairness play out in practice?
Well, the CFA source mentions things like cognitive errors, people making mistakes, or having imperfect self-control. Regulation often tries to account for that, maybe protecting people from overly complex products or impulsive decisions.
Okay. Protecting people from themselves sometimes. How does that connect to food speculation?
The food speculation source really dives into this. It talks about futures markets, where big players like hedge funds running commodity index funds speculate on bundles of raw materials, agriculture included. Their main goal, profit. And speculation, well, it tends to thrive when prices are volatile, swinging up and down.
Right.
And this source makes a really pointed comment. It basically says, for farmers looking to hedge price risks in these markets, it's like asking the fox to guard the henhouse.
Wow, that's strong.
It is. It raises a serious ethical concern. Does speculation-driven activity actually help producers manage a risk, or does it just amplify the volatility they're trying to escape? Does it serve their needs?
Is there an example of where financial engineering, maybe not weather specifically, but related derivatives, caused ethical concerns?
Yes, the SAMMF source discusses the Blackstone manufactured defaults case. It involved credit derivatives, not weather, but the principle is relevant.
What happened?
Essentially, the allegation was that the firm took actions to deliberately cause a company to default on its debt because they held derivatives that would pay out handsomely if that default happened.
So, manipulating the outcome to trigger the bet.
That was the accusation. Even if technically legal, it was widely seen as unethical, manipulating the underlying situation for financial gain through derivatives. It caused a big stir, got regulators like the CFTC involved. It shows how financial engineering can push ethical boundaries.
Okay, so we have tools potentially useful for hedging risk, like weather derivatives. But we also have large-scale speculation, especially in commodities, raising questions about fairness and impact. And financial engineering that can sometimes look, manipulative.
That sums it up pretty well. It's a tension.
So given all this complexity and the ethical flags, what about regulation? Are there gaps, blind spots, especially for these kinds of financial products?
Well, history gives us context. The food speculation source notes the U.S. government did heavily regulate food futures back in the 1920s and 30s. They put limits on speculators.
To curb their influence.
Exactly. They tried to differentiate between speculators and actual producers or traders using the market for legitimate hedging. But Those limits, especially on major exchanges like the Chicago Board of Trade for wheat, have been raised significantly over the decades, particularly up to 2006.
Meaning financial institutions can hold much bigger positions now.
Much bigger, yeah, which changes the market dynamics.
And what about the derivatives themselves? Are they transparent?
That's a key issue, especially for the over-the-counter ones. The WDM source points out that because these are private deals, often no one on the outside knows what is being traded or at what price.
That sounds risky.
It was identified as a contributing factor to the 2007-2008 financial crisis. This lack of transparency makes it incredibly hard for regulators to track risk building up in the system.
So even if regulations exist, like requiring disclosure.
Right. The CFA source touches on this. Mandatory disclosure aims to fix information asymmetry, get the info out there. But just having information doesn't mean everyone can understand it equally, especially with complex finance. Nor does it stop impulsive decisions. Sometimes regulators might even use disclosure rules almost like merit regulation, denying registration for products deemed too complex or risky, effectively trying to control the substance through procedure.
It sounds like regulators are constantly playing catch-up with financial innovation.
To some extent, yes. And the CFA source also mentions a potential side effect that regulation focused on reducing risk might sometimes inadvertently discriminate against genuinely innovative but risky ventures, perhaps making it harder for smaller players or certain types of hedging.
So a history of trying to balance things, but ongoing challenges with complexity, transparency, and the sheer scale of modern finance, especially in these less visible derivative markets.
That seems to be the picture the sources paint.
Okay, let's bring it right back home. For you listening, the farmer dealing with weather realities. What can you actually do? What strategies do these sources suggest?
Well, first, don't forget the basics. The food speculation source reminds us of traditional proven approaches, things like government agricultural policies, though their form changes over time, and critically, on-farm diversification. Planting different crops, maybe mixing livestock, things farmers have done for centuries to build resilience against both weather shocks and price swings. That's fundamental.
Okay, diversification. Still key.
Absolutely. And remember that sources' warning about relying solely on speculative futures markets, the fox guarding the henhouse idea, it urges caution about markets potentially driven more by financial players than physical realities.
But what about the derivatives themselves? Are they completely off the table?
Not necessarily. SimTrade and the weather derivative source bring them back as a potential tool, specifically for hedging certain kinds of weather risk.
The kinds insurance might not cover.
Exactly. They can provide funds based purely on a weather outcome, say, that heat index trigger, which could help cash flow even if there's no insurable physical damage.
But with those big caveats we discussed earlier.
Huge caveats. The weather derivative source hammers this home. It demands deep understanding of your farm's specific vulnerabilities. How does your operation react to local weather? You need solid, reliable, relevant meteorological data.
Not just general forecasts.
No. The source says success hinges on combining good forecasts, a clear grasp of your specific revenue weather link. You need to quantify how weather hits your bottom line, and then a really structured approach to designing the contract. It has to be tailored.
Tailored. That seems crucial. Which leads perfectly into the bonus insight we wanted to pull out. How might a farmer spot potentially unsuitable, maybe even harmful financial products? The sources don't say predatory, but what are the warning signs?
Right. Let's piece together the clues. First, that opacity issue from the WDM source. If a product, derivative or otherwise, isn't transparent, if you can't clearly see how it works, what triggers it, what data it uses, how it's priced, to be very wary. Complexity can hide risk.
Okay, lack of transparency is red flag number one. What else?
Second, think about why regulations like suitability rules exist, as discussed in the CFA source. They exist because people can make mistakes, maybe due to lack of experience or understanding or feeling pressured. So a potentially harmful dynamic could involve someone pushing a complex product onto someone who doesn't fully grasp it. If the sales pitch feels rushed, confusing, or too good to be true, step back.
So high pressure or confusing sales tactics.
Definitely a warning sign. Third, and this comes directly from the weather derivative source advice, effectiveness relies on being specific to your situation. A derivative based on generic data, or data from miles away, or linked to a weather variable that doesn't actually affect your key risks. It might look like a hedge, but it won't function like one for you. It fails to provide meaningful protection because it's misaligned.
Like buying flood insurance based on rainfall 50 miles inland when you live on the coast.
Kind of, yeah. The risk profile doesn't match. Remember that Catalunya Caixa example? Not a derivative, but a complex deposit linked to market swings. People bought it maybe hoping for high yields, but the risks weren't clear and didn't suit many investors. A misaligned product.
So what's the actionable advice based only on these sources?
Be skeptical of anything that isn't crystal clear. Demand transparency on pricing, triggers, and data. Ensure any weather product is specifically tailored to your farm's unique, documented weather vulnerabilities and how they impact your finances, using robust, local data. Don't accept generic indices if they don't match your reality. Remember, regulators worry about mistakes and impulse. Take your time, understand it fully. Ask yourself, does this genuinely reduce my specific risk, or is it just a complicated bet? Get independent advice if you need it.
Understand your risk, demand transparency, insist on relevance. That's very clear. Okay, we've really journeyed through a complex topic today. We started with the basics of weather derivatives, saw how real weather impacts global markets, dug into the ethical debates around speculation, looked at regulatory challenges, and landed on potential strategies for farmers, including how to be cautious about financial products.
Yes, and the key takeaway is that these financial tools are increasingly part of the agricultural landscape, especially with climate change. Understanding them, their mechanics, the markets they operate in, the potential pitfalls is becoming really crucial.
Absolutely. And the sources consistently brought up that tension between efficiency and fairness in markets. It makes you wonder, as extreme weather likely becomes more frequent, how will that debate play out specifically around financial products tied to climate? And importantly, what role should those most affected farmers, people working the land, have in shaping that future? How do we ensure fairness keeps pace with financial innovation? Something to really chew on.
A critical question for the future.
Definitely. Well, thank you for joining us for this deep dive. We hope this has given you some valuable insights. Keep exploring, keep asking questions about how these big global trends connect back to your world. Hitting that like button and smash that subscribe.